Hi everyone, thanks for joining me for this edition of First Bank's Wealth Management Market Commentary video series. I'm Bill Dolan, Senior Portfolio Manager with First Bank's Wealth Management Group. Well, this year so far is shaping up to be quite a contrast from last year with respect to market volatility. This year, through June, there have been 36 trading days where we have seen the S&P 500 move by 1% or more in a single day, while in 2017, there were only 8 days in the entire year that saw 1% move in a day. And so far this year, we have 8 days where the S&P 500 has moved 2% or more in a single day, and this didn't occur at all in 2017. So what's more normal? Well, we have to look back to 1965 to find the last year in which there were only 8 days where the S&P 500 moved by 1% or more. But we only have to look back to 2015, which had 72 single-day 1% moves, to see a year with similar volatility as this year. Volatility in the stock market is normal and should be expected, and the low volatility experienced last year was indeed an anomaly. So why does volatility matter? Volatility is a statistical measurement that looks at the average, in this example, of yearly investment returns over some span of time, could be 20 years, could be 80 years, could be whatever you think is relevant, and measures how far away in the single year periods the returns are from their overall average of the time span. This measurement gives us perspective on uncertainty and risk. For example, U.S. stocks have returned about 10% per year on average for the last 80 years, but these returns have not been 10% every single year. Some years they're up a lot, like in 2013, up 32%, and some years they're down a lot, like in 2008, down 38%. But over time, the average is close to 10%. So stocks are volatile. Instead, if stocks return 10% on average over time, but each year the returns were much closer to its average, like 9% one year and 11% the next year, then volatility would be much lower, and investing in stocks much less risky. Unfortunately, this is not the case. Let's consider an example to show you why this matters. Let's say in 1998 you had $100,000 to invest, and you wouldn't need that money for at least 10 years. Over the course of the next 10 years, the NASDAQ had an average annual return of about 7%, and T-bills had an average annual return of about 3%. Which would you choose? Seems like the NASDAQ is the clear winner, except when we consider volatility and the effect that volatility has on compounding. $100,000 invested in the NASDAQ in 1998 was worth about $119,000 by the end of 2007. But $100,000 invested in T-bills in 1998 was worth about $141,000 by the end of 2007. So in this example, you had an investment with lower average returns, but with lower volatility, end up creating more wealth than the investment that had higher average returns and higher volatility. This is due to the volatility effect on compounding. The outcomes are also dependent on the sequence or order of returns realized. Meaning, did your investment start up and have a few consecutive years up before turning down, or did you start right out of the gate down for a few years before turning positive? This order or sequence can have significant impact on the growth of wealth. This brings us back to our ability to predict returns and sequences of return. Ideally, we would invest when the markets are starting to go up and then exit just before they go down and repeat. Unfortunately, for many reasons, the future level and sequence of returns is uncertain, and the outcomes of attempting this kind of in and out tactical strategy typically winds up badly. But because of the risk that volatility may impede compound returns, taming volatility is critical to long-term wealth creation. And taming volatility or managing volatility is accomplished through proper asset allocation and disciplined actions. We can help with these things, and I encourage you to email me with questions or comments at bill.dolan@fbol.com. Thank you for watching, and I look forward to hearing from you.